observe in the data is the correlation of MSCI US with the aggregate 22 developed economies. So when we think the MSCI countries, so MSCI is an index. It's like Standard & Poor's. MSCI stock market index is basically an aggregate stock market index of 23 biggest developed economy stock markets in the world. So MSCI countries are like usual suspects: US, Canada on that side. On the other side, we have Japan, Australia, New Zealand. Then we have European economies like UK, Germany, France, and Netherlands, and so on and so forth. I think that we have Israel, and so on and so forth. 23 countries like that. So we don't have developing economies like China or India and other developing economy stock markets, which constitute still a couple of percent of the total capitalization in the world. So MSCI index, which is composed of 23 countries, is mostly the world stock market representatives. Now, and when we look at also that group, what we observe is something quite interesting, which is when we look at the global stock markets, half of the capitalization is US. Yes, US might be producing 15 to 20% of the world GDP, but when we look at stock market, it's the half of the stock markets. The other half is the other countries like Japan, UK, Germany, France are the biggest ones, and the rest. So, and for that reason, it seems to be the case that US is somehow running the business in stock markets. So it can be thought of as a single body, and the other economies can be thought of as a single body also, which I will explain why we think this way. Now, correlation of the MSCI US stock market index, which constitutes half of the index, with the aggregate of the other 22 economies, which we call them MSCI excluding US index. The correlation between these two, which you can look at different correlations. So what we were looking is, we look at bi-weekly or weekly stock market indices. We calculate the correlations of this for 4-year intervals, and then we try to plot these average correlations, how it changes over time. When we look at this, what we observe is, while between 1986 and 1995, the correlation was around 0.37, the correlation sharply started to increase in the mid-1990s, and in the 2000s, it reached to a plateau of 0.8. So here we have this picture. So here what we have is the stock market correlations between US and the rest of the world, which we call them as the MSCI 22 countries. So when we look at the bilateral correlation between these two groups, what we observe is the correlation was around 0.4 from 1986 to 1994. Starting mid-1990s, it sharply increased and reached a plateau of 2010s, let's say after 2000, late 2000s, it reached a plateau of 0.8. It doubled, 0.4 to 0.8, you might think of. So there's a sharp increase in the correlation. So this is an important issue. Why is that the case? Because the thing is, one of the biggest motivations about investing into stock markets in different places in the world is diversification. Because when you invest into a stock market, there's risk. It's a risky investment. And to be able to diversify your risk, you should invest into different type of assets, right? The usual quote is, don't put all your eggs in the same basket. Now, this type of diversification will benefit the investor if and only if these stock markets all around the world move in different ways. Because when diversification means this, diversify the risk. If one moves up, if the other one moves down, then this means you're diversifying your risk, so you're not going to experience huge fluctuations in your portfolio. However, if the global stock markets start to move together, so the correlations increase at the same time, then the diversification benefits disappear. So then this means that investing into different global stock markets in the world now does not give you diversification benefits. So for that reason, these increasing the correlations have some this negative effect on the global investors. And why is that the case? Why for the portfolio investors these diversification benefits are decreasing? Well, the story that we are going to go after is I'm going to explain that what we think is the explanation for that. But I just want to tell you the motivation of that question, because it's going to be an important concept for the conjecture that we are after. Now, when we look at US versus the rest of the world, fine. But what about US versus other major stock markets like Canada, Japan, UK, France, and Germany? And then what about the stock market correlation between these countries, not US versus these, but what about the stock market correlation between UK and Germany, France and Japan, and so on and so forth? So we took the 6 countries in the world, which constitutes almost a big chunk, and look at all bilateral stock market correlation between these 6 countries. And what we observe is there are some changes in the level, there are some differences in the level of increase, there are some differences in the timing and so on and so forth, but in all of them we observe the same thing. Stock market correlation started to increase in the mid-1990s, or 1990s in general, let's say. So this means that there's something affecting these countries at the same time. It's not US versus the rest of the world. These countries between each other also experience similar increases in stock market correlations and a decrease in diversification benefits for portfolio investors, global portfolio investors. Now, so we are not the first guys who try to come up with a reason behind these, but so in the literature there are some papers, there are some work try to explain what is the reason behind these. Most of these, almost all of these explanations are different than what we are suggesting here. That's number one. And second thing, these are conjectures. So there's no empirical or a structural model that is used to understand this timing and level of increase in the global stock market correlations, to the best of our knowledge. But the alternative theories that people talk about, or the literature try to conjecture, is, first of all, business cycle synchronizations, which this is not the case that much anymore, because the business cycle synchronization, because the data that we have, the recent empirical evidence shows that actually there's not too much change in the business cycle synchronization all around the world. There's financial cycle synchronization all around the world, which we know now that in the last 15 to 20 years, in all countries there are financial cycles, and there's a synchronization in that, yes. But in terms of business cycle synchronization, it's not obvious. We will talk about that. Then there's monetary policy explanations, which there's a synchronization of the monetary policy all around the world, because of the financial cycles are also there's a synchronization in that. So monetary policy somehow is following these, reacting to that, if you believe in the Taylor rule. And yes, that can be one part of the explanation, but we will talk about that. That's not the major part. Then trade. What about trade? Because trade also increased all around the world. So can it increase the synchronization? Well, we're going to argue here in that paper also with a structural analysis. That's not the case. What about portfolio investment diversification? So what about if people invested more globally all around the world? Did they create these changes in the pricing pricing synchronization to go up? Because if people just invest in one country but not the other, then their investment behavior will affect the fluctuations in the price in that economy. But if they start invest everywhere in the world, then their investment behavior will be also synchronous all around the world, and as a result, maybe the pricing will be also the increase in the global stock market pricing correlations. Maybe it will be a result of the increase in the global portfolio investment. Well, first of all, we are going to show that both in the data and in a structural model, it's not the case. We're going to show in the data that the global portfolio investment level did not increase that much, as people think. Oh, it increased a lot because people are now investing everywhere. The data does not tell us that, to be honest. We're going to show the data to you. The second thing is, in a structural model, we also analyze that the structural model that we analyze FDI effects, the conjecture of that paper. We analyze the effect of somehow if the global portfolio investment levels increased, how does that affect stock market correlations? And in terms of mechanically, or the conjecture that the literature follows, we try to mimic that in our model, and we show that it does not create enough propagation in correlations. So And what is our conjecture is? Our conjecture is FDI. So the reason behind the increase in the global stock market correlations is the level of increase in the foreign direct investment levels, which this trend started to show up in the mid-90s. Now, and what is the reason behind that? What is the mechanism, and why, how level of increase in the FDI can create increase in the stock market correlations? I'm going to come to that. I just want to leave that with a question mark as of now. I just want to first of all show you the FDI trends. How did they look like, and how we, at least visually, how the trends in FDI and the trends in stock market correlations somehow show a similar trend. Then I will explain actually what's the link, how FDI can affect how the increase in FDI can affect can be contributing to the observed increase in the global stock market correlations. Now, okay, so this paper is about that, and so I'm going to come to the model back. So first, I would like to show you the data a little bit. Here we go. Now, if we take US versus rest of the world, because I showed you a couple of minutes ago how the data looks like. The stock market correlations between US and the MSCI excluding US, which we call the rest of the world. We know that the correlations, which is on the y-axis represented, was at a level of 0.4, and starting mid-1990s, it started to go up and reach to a level of 0.8. And on the left-hand side, on the right-hand side, I'm sorry, we have the FDI between US and the rest of the world. And how do we measure FDI? So what we observe in the data is both FDI in the United States from the rest of the world, and also the US direct investment in the rest of the world increase during that time period. So we have a measure which the literature uses that pretty much in a standard way. We sum up FDI stock in the United States, and we look at the US direct investment stock levels, capital stock levels in the rest of the world that's owned by corporations. We add these up, okay? And then we divide it with the GDP of US versus and plus the rest of the world. So since market correlation is a measure between two economies, we wanted to measure the FDI relationship between these two economies. So what's the way to measure that? You sum up the capital stock of each country in the other one and divide it with the total GDP of that economy. So how does that ratio change? So what we observe is that ratio in percentage terms was around like 5 percentage points up to the mid-1990s. Then it started to go up in the 1990s till the early 2000s, which, as you can see, it closely followed the change in the stock market correlations. And then this ratio started to flatten up, reached a plateau of around 10%, where we also see the same leveling in the correlations, which is not directly related to that probably because correlations can be at most 1. So there's an upper cap. So it's going to be a little bit binded there also. But the long story short, still we see the effect of flattening that follows closely in stock market correlations, closely follows the FDI trend between US and the rest of the world. So it seems to be the case that these two series follow each other pretty closely. Now, when we look at the FDI levels between these 6 major economies, because I showed you the stock market correlations between 6 major economies in the world, they follow the trend between US and the rest of the world closely. What about FDI? We see a similar thing. FDI is a little bit more blurry, the picture, and the reason for that is countries sometimes have a bilateral private relationship like US versus Canada that already have significant levels of FDI levels. So the level of increase there will be a little bit more limited maybe. But well, long story short, still what we see is the timing, the reaction can be a little bit weak, but what we observe is still the FDI levels in the mid-1990s for all countries, between each countries, increased. And the measure that we are using here is the same for each subgraph. The FDI stock in both economies for other divided by the GDP of the sum of GDP of these economies. So, okay, there seems to be these two trends are aligned with each other, right? But what is the story? So why FDI contributed to the increase in global stock market relations? What do we think? So there are two reasons for that. Actually, they are linked to each other. First of all, which one of them is mechanical, the other one is a little bit more conceptual. So think about two countries. They have capital stocks in each. So there are economies which do not have any FDI in the other economy, and they're just domestic. There are two domestic firms in these economies. These are the representative firms in these economies, and these two economies are subject to local productivity shocks. So which means that each economy will be affected from its local productivity shocks. As a result, the production will react to that. As a result, the earnings and the dividends that are distributed by these firms will be affected from local productivity shocks, right? And the value of the firm, each firm, which is the stock market value, we will interpret it this way, is going to be the present discounted value of these dividends, earnings, which means that these will also be affected by just the local shocks. So also the prices will fluctuate accordingly. So the stock market prices of these two economies, their correlations will be directly affected majorly by the correlation of the TFP shocks of these economies. That's it. How correlated are the TFP shocks of these two economies? Activity shocks of these two economies? The stock market correlations will be in line with that. So that's going to be the only effect. However, in that set, assume that these two economies started to have plants in the other one, which means that now, let's say, US firms do not only produce locally, but they produce at home, but also away. And the foreign plant, the away plant, overseas plant of the US corporation now is going to be affected by the TFP shocks of the overseas economy, which means that the dividends, the total dividends that will be distributed by the US corporation will be coming two places, local plant and foreign plant. The local plant will be affected from TFP shocks locally. The foreign plant distributions will be affected from the away countries TFP. So as a result of that, when you have more operations outside, your dividends, the dividends that are distributed by US firm will be also affected by the TFP shocks of the away economy. So how big is that magnitude? Away operations, the dividends will be more affected from the foreign TFP shocks, and vice versa. The economy, it will be the same. So which means that if countries start to operate in the other economies more and more, their TFPs, and so their dividends will be more correlated with each other, because a part of their TFP dividends will be affected by the outside countries' TFP shocks. So as a result of that, mechanically, first of all, more FDI operations will make the dividend distributions, earnings and dividend distributions of these two countries, multinationals or firms. It will increase these correlation, the dividend correlation of these two economies. So the price correlations. So stock market correlations go up just for that reason. That's number one. Now, the number two effect is what we call technology capital. The technology capital effect. So what is the technology capital effect? So the thing is, multinationals are a little bit different than local firms, because a local firm produces locally, all operations are local, and when a local firm invests into capital and also invest into research and development, which will create intangible capital, or let's call it technology capital, both tangible and intangible capital will be used in production, but locally. But when a firm goes multinational or goes overseas and starts to operate there, in general, what we observe in the data is, if you open a plant overseas, you have to make extra tangible capital investment there. You have to build a plant, you have to build machines, and so on and so forth. However, the technology capital that you're using overseas, you don't have to do this investment again. This technology capital is going to be produced at home and used at home, but also it will be utilized free of cost at away plants, which means that any shock that any shock in the US economy, which affects the investment behavior of the domestic plant, directly will be translated into the foreign plant, with the technology capital. And when you have more, when your operation level is higher, you have FDI levels outside the economy more and more, the effect of the spillover technology to the rest of the world economy will be also more. And this technology capital's global spillover effects will also increase the stock market correlations, because this technology capital is used overseas. The reason why the local firms invest into technology capital is not anymore only the utilization of that at home, also at away plant. And when the away economy, the overseas economy gets a TFP shock, it's going to affect the return on technology capital, because multinationals are not investing in technology capital just for local production, also for away production. So this means that normally when each plant just has tangible capital and no technology capital, a shock at the overseas is going to just affect the return of the overseas plant. It does not directly affect the return of the domestic plant, because their investments, capital investments are separate. Even though it's the same plant, they're separate, the same firm, two different plants. But if there's something called technology capital that is invested at home but used cost of free at the away plant, a TFP shock that the away plant gets in the outside economy, in the rest of the world economy, it's going to affect the return of technology capital as a whole. So it's going to affect the production of the domestic firm also, because the spillover effect has negative effects. So for that reason, when there's more technology capital because of FDI, the shocks in the other economy just does not just affect the dividends that are coming from the overseas. It also affects the technology capital investment of the multinational as a whole, which will affect the local production and also the dividends that are created by the local plant. So this means the correlations, stock market correlations, once more will increase when there's more technology capital used in the production, which will be the case when you have more overseas operations. So for that reason, we believe that the global stock market correlations increase for two reasons. First, FDI operations increase all over the world between countries. This mechanically, for the mechanism that I explained, increase the stock market correlations. And second, since multinational firms use technology capital more, this technology capital with the spillover effects magnify to the increase in the stock market correlations in the world. So that's the mechanism that we have in our mind. Now, we wanted to, so this mechanism, what we're going to do is we're going to analyze this mechanism in a general equilibrium model, a stochastic general equilibrium model, a two-counter asset pricing model, which I will explain the details in a couple of minutes. But about this conjecture, we also want to provide some evidence, right? So first of all, there are evidences in the literature. So there's a recent paper by Bilgi and Morales, which is published in Journal of Political Economy in, I think, 2020. This paper looks at, for the US firms, which they have an access to a confidential data from Bureau of Economic Analysis, which we cannot look ourselves. So what they do, they calculate the return to US R&D, okay, US plants, they do R&D, and then the return to this R&D, how much of that comes from the local production, how much of that comes from overseas. So they try to see how the foreign overseas operations use this domestic R&D investment, how intensely they use, right? What they find is the total return to US parent companies R&D that's done in the United States, 20% of that comes from overseas, and 80% comes from the local operations. And during the time period they look at what is the level of FDI of the US plants in the rest of the world, and what's the level of FDI local operations, that's the size of the local operations. They find it's also 20 to 80%. And with that, they conclude with the following. the whole technology capital, that's R&D investment, that's done at the parent company, it's one-to-one fully utilized by the away corporations. Because how much the local R&D will get its return? How much from the away, the foreign plant? How much domestic production? What will affect these return percentages? Two things: the level of FDI and how much the foreign plant, how intensively it uses the local R&D. If the return shares are 20 to 80, and also the FDI levels is 20 to 80, then this must be the case that the foreign plant using the local US domestic R&D investment 100% fully. It utilizes fully with free of cost. That's what they find. Now, this first of all shows the existence of technology capital, because if the technology capital was not used in the overseas operations, the 100% of the return of the US R&D investment will come from US plants. But that's not the case in the data. This means that there's something called technology capital, which is the investment is done at the parent company and it's used freely in the overseas. And how much? Fully. That's what they find. Now, on the top of that, so this shows us the existing of that technology capital. Now, but does it affect really stock market correlations? That's what we need, right? So to analyze that link, we basically use another data set, which this is Orbis. Bloomberg and Orbis. We use two data sets, and we try to link this existing of technology capital, FDI levels, and the stock market correlations. How these two things affect the increase in the stock market correlations. That's what we want to look. And how to analyze that? We try to come up with an analysis at the firm level. So, if a firm is multinational, it will have subsidiaries in countries other than the one in which it's incorporated, right? That's the definition of FDI. The hypothesis one is stock returns of publicly quoted companies with no foreign subsidiaries will correlate with less with foreign stock market indices than those companies with foreign subsidiaries, right? Which means that in US we have multinationals and we have just firms that operate locally. If you look at the stock prices of these two type of corporations and look at the correlations of that with the, let's say, MSCI excluding US, the aggregate index, we should observe, logically, according to hypothesis one, that firms with FDI will be more correlated with the rest of the world than firms that are just local. That's hypothesis one, according to our conjecture, right? And the hypothesis two is multinational firms that engage in more R&D and invest more in intangible capital should have higher stock returns that correlate with the international stock markets, right? So, okay, this means that firms with more R&D, but also with more FDI, because the spillover effect does not come from R&D. You can be a high-intense R&D firm, but no FDI. Then there will be no spillover effect to the rest of the world. So the hypothesis, you should have more R&D and more FDI. Then your stock market correlation with the rest of the world should be higher than the one with low levels of FDI and R&D. So that's the hypothesis two. So how can we check these two hypotheses? We looked at the micro level data. We looked at Bloomberg and Orbis. Orbis is a data set that includes, I don't know how, but hundreds of thousands of private firms all around the world, and the balance sheet information and sometimes real data for these, like the employment level and so on and so forth for these firms. So we looked at so what we do is, but the thing is, of course, the data is not that complete all the time. So what we are focusing on is we are looking from January 2016 to December 2019. Okay, we don't want to look at the pandemic. US firms that are listed in US stock markets in that 4-year window. And there's a couple of filtering we do, which I will not go into the details. We find around 2,300 firms. We have the stock market data for these firms during that time period. So what we do is we looked at the stock market correlations for these firms with the rest of the world, MSCI world excluding US. So we are trying to see how these firms are correlated with the MSCI world excluding US, their stock prices. We cannot look at a trend because it's a very short time period and it's after the transition that we just showed. But that's a cross-sectional analysis. So what we want to do is we want to find these firms and their correlations with the rest of the world stock markets, and then say that, okay, conjecture is countries with FDI should be more correlated. Countries with R&D and FDI together should be more correlated because of the spillover effects. Okay, so then what we do is we regress the correlation of these companies with the U.S. global stock, the global stock market levels, the global stock market prices, and the exploratory variables are FDI level, R&D level, and an interaction term. We need the interaction term because the thing is the R&D spillover effect will only work if the company has FDI, because you can be doing locally R&D, but if you don't have any FDI operations, then there will be no spillover effect that's coming from the rest of the world, so it doesn't make sense, right? So when we do this regression, what we find is the following. So there's a different type of regressions that you see here, but I would like you to suggest to the third and the fourth columns here. So here, the explanatory variables are if you have foreign subsidiaries or not. It's a dummy variable because in the Orbis data we can only see if you have foreign plants or not. We cannot see the level of FDI. Then intangible capital, so the R&D level you have. So for that, in this third and fourth column, we pick the intangible fixed asset to tangible assets and intangible fixed assets to tangible fixed asset ratio. So this is basically technology capital stock to total capital stock that each corporation has. We have data for that. And then a multiplication of the dummy and the R&D. So that's the interaction term. So when we run these regressions, the critical thing that we want to see is the following. First of all, as you can see, FDI is always significant. And the next, so because more FDI means more correlations, that's fine. The next thing we really want to look at is if the interaction term. Because if R&D is not that important, it's just all FDI, this interaction term will give us insignificant results. That's not the case. We get significant results. So which means that R&D together with the FDI, there are some spillover effects that we want to focus on, right? This link seems to be somehow, I mean, that's a simple regression analysis, but somehow shows up itself in the regression. So this means that the R&D spillover effect that comes from FDI, somehow there's some evidence to that in the data also. Now, all right, so this is the conjectures that we have, and we want to see how much the level of increase in the FDI that we observe in the data can explain the increase in global stock market correlation. So I will go to the model, and then I will present you the results. So at that point, I would like to just stop and ask if anybody have any questions. I would like to clarify things if you have any questions. Okay, so let me continue. Okay, so we have a model. We have a neoclassical approach here. We follow the neoclassical approach. We have a two-country dynamic stochastic general equilibrium model and asset pricing model. So time is discrete and denoted by small t is equal to 0, 1, 2. We have two countries, US versus the rest of the world. Now, the firms. Each country has a representative multinational. By the way, in the notation, that's quite important to clarify. The countries will show up in the subscripts in the variables. Okay, in the subscripts, we're going to show you the country. We're going to tell you the countries and the firms. So the source. The firms will show up itself in the superscripts. So each country is a representative multinational. And each multinational operates factories both at home and abroad. So two economies, each economy is a multinational. Each multinational has one here, one there. So in each economy, there are two plants, one domestic, one foreign. Each multinational operates production factories both at home and abroad, and these plants have capital, own the capital, and they invest. And there are shareholders that own these firms, and they pay dividends to their shareholders. Okay. Now, as of now, in the benchmark model, we assume that each firm is owned locally. So there's no cross-border portfolio investment. So citizens of an economy purchase their local plant's share, local firm's shares. They don't buy foreign firms' shares in their portfolio. They don't hold them. And we're going to extend that actually assumption later on. Now, households are representative. In each economy, there's one household. The households are standard. They have constant relative risk aversion functions, which I will explain which form we assume. They consume, they work, and the labor supply is inelastic in that version of the model. So each household has 1 unit of labor that they supply inelastically. They own the shares of the home firm, so there's perfect home bias, as I told you, and they earn labor and dividend income from their investment. Now, all right, so here, let's talk a little bit about the notation. Y is the production of a plant. So the production of multinational H in country I. So as I told you, the firm is represented in the superscript. So if this is a US firm, H will be US or whatever the indication of that is. And I, the subscript, is the destination. Where does this firm operates? So let's say we call US 1. Okay, let's call US with the indicator 1 and the rest of the world 2. So Y11 will show you the US firm's production in United States. And Y12, H is 1, I is 2, is going to tell you the US firm 1 operating in the rest of the world 2. So superscript is the firm, subscript is the destination of production. Okay, location of production. Now, the total production in an economy is going to be the superscript. The subscript will be always II. So let's say in country I, who produces? In country I, H is equal to I. There's local production, and H is different than I, which means the other economy is producing in your economy, right? So the production of that plant. So that's going to be the plant. That's going to be the total production in an economy. So that's going to be the gross domestic product of an economy, because gross domestic production comes, a part of that domestic firms, a part of them comes from the production in your economy by foreigners, right? Now, production in each plant is done by 3 factors of production: labor, tangible capital, and technology capital. So labor and tangible capital, as you can, has a subscript and superscript, and subscript, which means that these are plant specific. Each plant employs picks the level of employment and the level of tangible capital stock in production. However, technology capital, as you can see, has only superscript, no subscript. Why? Because technology capital for a multinational firm H, let's say US firm, so M1, it's going to be just one capital stock that's going to be used both at home and abroad. So there's no subscript for M, because technology capital is used in both plants. Now, that's the trick that we talked about spillover effects. Now, the production function is going to be looking like this. I'm going to just give you general functional forms now. I'm going to specify what functional forms specifically these we pick. Now, production is going to use, in, let's say, the multinational H producing in country I. The production of this plant is going to be determined by the level of labor, level of tangible capital, and these 2 things are specific to that plant. Then the technology capital of the multinational, right? So these are going to be combined with a Cobb-Douglas, with a constant return scale production function. So the factor shares in the production of these 3 is going to be add up to 1 in each plant. And the plants are symmetric, by the way. Both countries, all plants use the same production function in that sense. Now, the difference is here. AI is, as you can see, the destination specific productivity. So that's the country's productivity level, general productivity level. So it's going to be the, there's no time subscript. So it's going to be, let's say, the productivity level in United States. or productivity in the rest of the world. So if you're a US multinational operating in the rest of the world economy, this productivity level will be the rest of the world economy's productivity level because you're producing there. Now, ZIT is the shock. So the mean of that is 1, and ZIT is the level to the general productivity shock at that economy. So as a result, a US firm operating in the rest of the world is going to be affected by the productivity shocks in the rest of the world. So that's the level of productivity, that's the shock to the productivity. Now, there's a term in this productivity component, which we call sigma HI. This is the plant level productivity level. So US plant H operating in country I, the specific productivity level of that plant is going to be sigma HI. What about the, okay, and that's going to be smaller than 1. Why is it the case? Because the rest of the world firm operating in the rest of the world, so it's local production, it's going to be what? This is going to be sigma II, right? That's going to be equal to 1. So each plant that operates in its own economy, the sigma is going to be 1 for that economy. That's what we assume. However, for the foreign producers, like US firms producing in the rest of the world or rest of the firms producing, plant producing in US, the sigma for this is going to be smaller than 1. Why is it the case? Because when we look at these economies, what we observe is FDI levels are always smaller than domestic production levels. Why is that the case? Why not everybody is coming and producing in my economy? Because there are different frictions, right? Information frictions, cultural frictions, uncertainty frictions. So for a foreign plant to come and produce in your economy is a little bit different than a domestic producer producing in your economy. So for that reason, this is going to be the productive differences between the foreign producers and domestic producers in an economy, and that's going to be calibrated to match the FDI levels that are observed in the model, in the data. And to so this modeling assumption is not coming from us. It's not our assumption. So this is the assumption that Gretton and Prescott in 3 or 4 papers that they use a similar model to model FDI in a general equilibrium setting actually picks. So we are following their notation and their approach there. And they call the sigma FDI openness parameter because it's going to determine how much FDI is going to exist in an economy, right? So if sigma is 0 for a foreign plant in the United States, then there will be no FDI in the US. But if this goes up, the level of FDI in the United States will go up because the foreign plants will be more productive in your economy. Now, then what we're going to do is we're going to calibrate this sigma to match the FDI levels in the rest of the world, United States. And then what we're going to do is after we calibrate our model, our stochastic model, and calculate how the stock market correlations, what are the stock market correlations that are implied by our model in our benchmark calibration, we're going to increase these sigmas in both economies to match the level of FDI increase that we observe in the data. And then, as a result of that, each country's foreign plant will start to grow exogenously. We calibrate for that. And then we see how this thing affects, how this change affects the stock market correlations in the world. So that's the mechanism, that's this actual simulation that we're going to conduct in this exercise. All right, so this is how the production functions look like. Now, next, the investment functions. So, of course, each plant invests into tangible capital stock itself. So the tangible capital stock investment will be the difference between the next capital stock and the level of capital stock today after depreciation taken into account. And we also assume some adjustment costs, which will be crucial for our analysis, which I will explain. And also the technology capital follows the same level of motion. So the same accumulation functional form that we have, we assume the same thing for the technology capital. And then this is the firm side. So this is the functional forms that we're going to use in the firm side. So what does firms do? As I told you, each country has a multinational, and each multinational operates 2 plants, one at home, one abroad. So each multinational is going to maximize the discounted value of the dividends that comes from home plant and the foreign plant. So, for example, I is equal to 1 to 2. So for the multinational H, there will be 2 dividends one from home production, one from away production. So I will sum them up, and then I will discount them to today, all the dividend distribution that I expect for today to infinity. And this is the discount factor that's going to come up from the household's maximization problem, actually. And what the dividends look like for what are dividend distributions of the home plant and the away plant. So the home plant, let's say multinational H, producing at home, I is equal to H, produces, pay wages to the labor employed, invest into technology capital, invest into tangible capital. So after the investment in both capital stocks and the wage payments are subtracted from total production, the rest is distributed by the local plant. The away plant, I is not equal to H, produces, pays wage bills, and invests into tangible capital stock. And when you deduct these from output, this will be distributed. As you can see, there's no deduction for technology capital for the away plant in the away plant's cash flow equation, because the away plant uses this technology capital freely in production, but does not pay anything for that. Okay, so these are the dividends, and these two dividends will make up the total dividends of a multinational in a period. When you discount that, you find the total stock price, total value, the total stock price of that multinational. Then, okay, so what is the optimization problem of the firm? The multinational is going to maximize the present discounted value of the dividends that comes all over the world, subject to the cash flow constraint of the two plants and the capital accumulation functions for tangible capital and technology capital. So that is the optimization problem of a firm. Now, okay, the thing is, one can show analytically, after some math, after some tedious math, one can show the following. The stock price of a corporation, the stock price of a multinational can be written in terms of the capital stocks and the investment levels and the adjustment cost function. These three things will determine the price of a multinational. Now, as you can see here, the price of a multinational is affected by dividends, right? But if I replace these dividends inside, I replace also the accumulation functions for capital stocks into this equation and do tedious math, at the end, what I'm going to get is, as you can see, the only thing that affects the price of a corporation is the level of capital stock that you have for all these three. So you see, the level of capital stock of a plant is tangible capital stock in both plants and the technology capital. So tangible capital stock at home, tangible capital stock away, and the technology capital stock that you have. And if there are no adjustment costs, let's say adjustment costs are zero, and you're a closed economy, there's no technology capital, and there's no tangible capital away, then the price of an economy, the price of a stock will be equal to its local tangible capital stock. P is equal to K. That is the result that we know from the standard general equilibrium models, where the Tobin skew, which the price of a firm divided by its tangible capital stock should be equal to 1 normally, when there are no frictions, there are no away productions, and so on and so forth. However, the thing is, that's not the case in the data. We know Tobin skew is different than 1, and there are different explanations for that. One of them can be technology capital. The other thing can be you might have away production. The other thing is tangible. There's cost of capital adjustment cost, and all these three things can affect the level of price for stock. Can affect the stock price of a corporation. So the thing is, the co-movements between the stock prices of two economies, if it goes up, the correlations go up. Some correlations here should go up. The correlations of tangible capital investment or the correlation between technology capital investment of these firms should be going up, right? So that's the insight we should get from that derivation. Co-movements of stock prices depends on how capital stocks investment across firms location co-vary. Now, then what we do is This is the firm side. We are done with the firm side. Let's look at the household side. So there are one representative household in each country, right? Now, the households will consume, invest into the stocks of their home multinationals. And then, of course, there will be international borrowing and lending. So we are going to assume three types of financial market structure for this international borrowing and lending, which one of them we will call autarky, financial autarky, where households do not trade any other assets with the households of the other economy. You don't trade with the rest of the world in terms of bonds or like liquid investments. You don't trade directly. Well, then we have a complete market setting where there's perfect risk sharing among the households of two economies. So for that reason, marginal rate of substitutions across economies are equalized. So these economies, the two country citizens, which are subject to different shocks, TFP shocks, trade with themselves by using contingent lending instruments. As a result of that, their consumption is going to vary one-to-one with each other, perfectly correlated, because they're perfectly risk sharing. So financial autarky is completely the opposite of that. And then incomplete markets, which is probably the realistic case. There must be a level of contingency in the markets, but there must be some kind of also completeness in the market. So markets are not that complete, but we are not in financial autarky. There must be some in-between case, which we call that the incomplete markets model. How do we model that? We model that as households can still trade with each other, can borrow and lend from each other directly. However, there are some costs they have to pay, some borrowing costs. And we calibrate these borrowing costs to match some macro aggregates. We're going to talk about that. Now, the setup of the household is going to be as follows. The household will maximize expected value of the utility, subject to the budget constraint, right? Now, of course, the budget constraint will reflect the things that I just told you. So for the benchmark case, for the incomplete market model, households will consume. So the household income will be here, which is going to be their wage income. And from the shares that they own, they're going to sell these shares and get their capital investment back. And they will be also given, there will be some dividend distribution from the home plan and their way plan. So that's from the stock market. That's what their income is going to be. And this is their bond income. If they blend it, that they will borrow, they will be paid that back. If they borrowed, they will pay that back. That will be negative, right? So that will be their total income. And what do they do with their total income? They either consume, they buy new shares, and they lend to the other economy a new amount of funds, or they borrow from the rest of the economy. And this borrowing with the rest of the relationship with the rest of the economy is subject to some costs. That's what makes the market incomplete. And I'm not going to explain, but in the financial autarky case, this goes. There's no B's here. So which means that your income is your wage income and stock market investment income. And what you do with that, you consume or buy new shares, and that's it. There's no international lending. This part goes, this part goes. That's the financial autarky case. In the complete market case, these debt instruments are the contingent instruments, which gives which provides perfect insurance between these two type of agents in these two countries, which I will not go into details of that modeling, because some of the people in our audience, like probably students, may be not familiar with this type of contracts. Now, that's, I mean, just knowing the intuition of what market completeness is, I think is enough to understand the results in our model. Now, then there's here markets clear, labor market, stock market, bond market. So I'm not going to go to the market clearing conditions in details, and I'm not going to go over the definition of the equilibrium also. I mean, these are just some technical details which we don't need to know at that point. Now, okay, so the calibration, let's calibrate the model and let's see the results, how the change in FDI affects the stock market conditions in our model. That was, sorry, I think I got something from the chat box. All right. Okay, now, let me explain a little bit the calibration directly then. So in the calibration, we calibrate the productivity level difference between economies to the GDP level difference between US and the rest of the world. And we also consider the population level difference between these two economies. Investment adjustment costs are picked to match the level of volatility of tangible capital investment to GDP in each economy to the level that we observe in the data. The depreciation level of these capital stocks are from the literature, from the data. It's quite standard, so I'm going to skip it quite fast. So the openness parameters, sigmas, are calibrated to match the FDI levels before 1994, before just the change in the trend. So here, let me give you some information about that. Between 1995, 91, and 95, the tangible capital stock that the US corporations have in the United States, let's call it K11. And let's call the tangible capital stock that the US corporations have in the rest of the world, let's call it K21. Okay? K12. This was 0.15. K11, K12, K11 ratio, which means that if US corporations had one capital stock in US in the early 1990s, they had 0.15 capital stock in the rest of the world. And what about the rest of the world in US? The ratio was 0.12. Now, in 2011 to 2015, or post period after the level of FDI increases, for the United States, this ratio increased to 0.5, which means nowadays, if US corporations have one capital stock in US, they have 0.5 capital stock in the rest of the world. It's a huge increase. And for the rest of the world corporations having in US, the capital stock level increased to 0.31. So the level of FDI increased a lot. And we changed the sigma levels to the new level to match the level of change in the capital stocks that we observe in the data. Okay. And then we, of course, this will mechanically and also from the already spillover effects will increase the stock market correlations, right? How much? Let's come to that. Let me skip these parts and let me try to come to the results. Here are the results that we get. Now, in our model, and we are looking at the incomplete market model. Incomplete markets is our benchmark. The level of price correlations in the early 1990s in our model turns out to be 0.37, which we calibrated actually to match these levels. So it's not a surprise. So when we decrease the level of FDI, increase the level of FDI, sorry, to the levels that we observe nowadays, the model creates an increase in the stock market correlations to 0.511, 51%, let's say. So the level of increase is 0.37, 0.51. It's around 14 percentage points. 14 percentage points. Now, the level of increase that we observed in the data was around 0.4 to 0.8. So it was like 40 percentage points. So we create 14 percentage point of increase or model. The actual increase in the data is 40. So if you just divide them to each other, you're going to see that we can explain it around 1/3, 33%, 34%, 1/3 of the observed increase in the correlations in our model. So the level of FDI increase that we observe in the data in our model can explain 1/3 of the observed increase in the stock market correlations. That's what we get. Now, I'm going to skip these impulse responses because we don't have time for that. But what about so I'm going to just skip these technical parts. What about the financial autarky and complete markets model? So in each of them, what we see is the level of effect of FDI is always positive. So here we explain 14 percentage points in correlations. In the FA model, financial autarky model, the level of increase is again around 14 percentage points. In the complete market model, the level of increase in the actually correlations is more than 14 percentage points, like 18 maybe. So this means that the results that we get or incomplete market model is actually maybe the bottom, so the bottom of the range of estimates we can get. That's one thing I would like to say. The difference between these two models are these two models imply different levels of anti-correlations, which, for example, for the complete market model, we don't get the level of correlations in the 1990s in the model and in the data. This tells us something maybe that Actually, the markets are not really that complete yet in the 1990s, right? But our incomplete market model, and long story short, can somehow match 1/3 of the increase in the correlations. And as you can see, the level of increase in the correlation in the prices closely follows the level of increase in investment correlations between these two economies. Why? Because of, we actually theoretically showed that, because of the capital price mapping we have. Price and capital stocks and investment here. We call that the capital price mapping. Because of the capital price mapping we get that we show theoretically, we see a close link between the correlation in the prices, the correlations in investment, and also the correlations in capital stocks, more or less. All right. Now, this is the results that we get from our model when we just look at the level of FDI. Now, there's one last thing I would like to say, talk about, then I'm going to wrap up the results, which is the following. Now, we talked about some alternative explanations, right? That's provided in the literature, like trade is one, portfolio diversification is another one. So we wanted to check in our setup, in our setting, structural setup, if these explanations somehow can contribute to the increase in the stock market correlations. So then what we did is we extended our model with trade and portfolio diversification. So with portfolio diversification, we actually allowed each citizen in an economy to buy stocks of their domestic corporations, but buy stocks also of the foreign corporation. So this way, we allowed portfolio diversification in our model. That's one. The second way we extend the model is we extend the model to have trade. So what we did is the standard things. We have an Armington aggregator where the citizen in each economy has preferences over goods that are produced by the local firm and that's produced by the foreign firm. And then there's another aggregator, aggregator for the foreign firm's production, consumption goods production, where a part of that can come from FDI, a part of that can come from trade. So this way we introduce trade by using standard theoretical insights from the literature. And then what we did is we increased the portfolio diversification levels to the one that we observe in the data. And also we increased the level of trade in the model to the levels that we observe in the data by reducing the trade costs and so on and so forth, which are exogenous in our model. And then we calibrated our model like before, but this time we changed three things: FDI, trade, and portfolio levels, international portfolio diversification levels. So we calibrate our model to match these levels for the 1990s. And then what we observed, what happened to these things in the late 2000s or nowadays. And when we changed all these three together at the same time. And then what we did first, and what we did is the following. First, we look at how the price correlations change before and after, when all these effects are included. The results did not change that much. As you can see, the before correlation is 0.37, the after correlation is 0.51. So we get almost the same results that we get with the case where we don't have trade and portfolio diversification. So which gives us an idea that these things are not important. But to see that, what we did is the following. From this benchmark, where we change all these three things at the same time, portfolio diversification, trade, and FDI levels, now we close one of them at each time. So for example, when we close the portfolio diversification in our model, we calibrate the model in the ante period, for the 1990s to match the diversification, trade, and FDI levels. Then this time we increase only FDI and trade, but do not change the portfolio diversification level. So that's no portfolio diversification case is this. What we observe is actually we see a higher increase in the correlations, not from 0.37 to 0.51, but to 0.54. So it's a 18 percentage point increase. So this means that the portfolio diversification is actually reducing the stock market correlations, not increasing it. Why is that the case? I will explain you the reason for that. So at the beginning of our talk, if you remember, I was saying that some people are thinking that portfolio diversification benefits decrease because stock market correlations are now high, right? And there's a reason for that. Because the thing is, now, the reason people want to diversify is because things are risky. Investment is risky, right? Now, and the reason people want to diversify their portfolio with global investment channels is because the stock market move in different directions, and as a result of that, they would like to diversify. They want to take position in different, so they want to take a position in different stocks all around the world. Now, the thing is, if a firm does not stay local and go and invest into another economy, now the stock market price will move together, right? And the reason for that is the management of the firm is diversifying itself. The management of the firm does not want to be affected by just the local shocks, but just going and operating in different economies. Actually, the managers of the firm themselves diversify the risk just by changing their production structure and making their total output subject to different type of shocks. And when you do, the managers do this diversification for you, now the portfolio holders do not want to do diversification anymore because they don't need to. Somebody else does it for them, right? So, and for that reason, when portfolio diversification in our model goes up, this has a negative effect. It somehow squeezes the stock market correlations. It conflicts with the one that the managers do. And that's what we observe here. Now, with the trade, also, this last case that I'm going to talk, and then I'm going to be done with the presentation. Now, in the last case, when we close the trade channel, which means from our untapped calibration, we change the FDI levels and the portfolio diversification levels, but do not change trade, actually, we see a bigger increase in correlations. We see an increase of 20 percentage points, which is that actually, which I'm not going to go to the details of that because I think I don't have time and somebody is writing me in the chat to wrap up the results. The traders also, because as I don't forget, trade and FDI are fighting with each other in these kind of models. Because if you go to a country to open a plant, then you're not going to trade with them anymore, or you're going to reduce your trade volume with them because that's the logic of that. You don't want to export, you want to go and produce there. So this result is a little bit linked to that intuition, the trade-off between the trade-off between FDI and trade, which I don't have time, so I don't want to go into details of that. So from that table, the message, the punchline that you should get is trade and portfolio diversification does not seem to be contributing that much or at all to the observed increase in the global stock market correlations, and FDI can explain around 1/3 of it. Now, of course, there are many other things like monetary policy or the synchronization of financial cycles that might be contributing in explaining the other half or other 2/3 that we observe in the data, but that's outside the scope of our paper, and this paper is just trying to focus on a specific particular channel. Okay, that's all I would like to say. There are other things maybe I could talk about which I had time, and probably that means that I did not use the time that wisely. But if you have any questions, please let me know. Otherwise, I guess I should stop here.
Thank you for your enlightening presentation, Professor Ateşağaoğlu, and I'm sure our students have found it very beneficial. Now we can spare some time for our students and attendants if they have any questions or comments. If there are, you can raise your hands. I mean, you can click the raise hand button and ask your questions.
Turkmen, I guess is a question.
Yeah, thanks, Erem. First of all, thanks for the great presentation. As you mentioned, as global stock market correlation goes up, the diversification benefits goes down. And my question is, how big you think is the total decrease in the diversification benefits? I mean, is it possible to quantify this decrease in diversification benefits?
That's a good question. So in terms, I mean, if you're asking in terms of our model is not a very good environment to measure that, let me put it this way, or to quantify that, because in our model, the portfolio choice decision is exogenous. So in one case, we assume that the households just invest into local stocks. And in the second case, in the extension, we assume that they may invest into global stocks, but we assume that ratio is constant. We assume that, let's say, they buy 90% of the local shares and they buy 10% of the foreign shares. So we hold that investment ratio constant in our model. It's not endogenous, let me put it this way. And for that reason, our setup is a reduced form setup in that sense. And in our settings, we cannot measure it. I think it's not a good set to measure these cost of these diversification benefits, the reduction in that. But from the data, I think there must be a way to measure it, because I mean, you know what the volatility is of different global stock markets. You can, I mean, the optimal theory tells you that based on these volatilities, what should be the optimal diversification, how optimal diversification should look like, what the share should be. And now if the diversification went down, what will be the new shares optimally to invest in at home and globally? And then based on these two different setups, how the volatility of your portfolio in total changes. And I mean, it is a vague idea that I just came up now. I think empirically, by following a strategy like that, I think you can measure it. But if you're asking structurally from our model is a reduced form model in the portfolio side. So it's not a good setup to measure it, to be honest.
Okay, thank you. Thanks for the clear answer. Actually, that would be maybe nice to empirically measure the decrease in the diversity benefits by using the data, maybe. And secondly, your setup is based on constant returns to scale. Is it possible to put your hypothesis in increasing returns to scale framework? I ask this because some of the international trade models are based on this assumption, and I am just curious about that, if you can put this hypothesis in an increasing returns to scale framework.
Sure. I mean, if you assume a monopolistic competition setup, as you know, or assume that these plants are producing intermediate goods and there's another firm at the aggregate level which creates a diversified good, right? That's strategy generally, to create these kind of things. Yes, you can do that. The problem we have in this model is the following, which is quite not standard in that sense. So in an economy, we have two different type of plants, right? And as of now, what we assume is they produce the same type of good. So there are no two different type of goods. So in an economy, the GDP is the production of these two plants, and then consumption plus investment is equal to this, practically. Local investment and consumption. So the consumption business is not diversified. So what we need to do for the mechanism that you're telling us is we have to find a way to differentiate between the goods that are produced by the local firm and the foreign plant, right? And the thing is, we don't know actually from the data how these things are treated and how we can diversify these two goods from each other and so on and so forth. So for that reason, technically, there's for sure you can do it. Technically, for sure you can do it. But how to calibrate from the data and treat these two different type of goods and combine them into a setting like you said, maybe I didn't think too much about it, but at first sight, it seems a little bit needs more work conceptually. Yes, it can be done. It can be for sure done. Yeah, I mean, the one thing is our setup, or how we model FDI and all these functional forms. Our setup is a setup that's proposed by McCracken and Prescott in 2010 for the first time. So first of all, our model is not very new. I mean, our model is exactly what their model is, but we are extending it into a stochastic setting because their model is a deterministic setting. They are looking at the growth question. or model is a stochastic setting with a couple of more tweaks. But for that reason, the backbone of our model is actually based on their model. So we did not think too much about the other parts, these kind of extensions that you just talked about. But sure, I mean, it's something to think about.
Okay, thanks for the clear answer. Thank you.
No problem.
Are there any other questions? I guess not. Hocam, thank you again. It was a great pleasure to host you here.
Thank you very much.
Orhan Erem Ateşağaoğlu was with us today from İstanbul Bilgi University. Thank you all. And see you in 2 weeks, I guess. On November 9th, we have another seminar with Erwin Decker. See you then. Bye.
Thanks.
Thank you.